Good morning. Nice to see you.
Great to see you as well. Glad to have you here. We'll invite everyone to send their questions in. It is the week that it is. Why do you say that perhaps whether it's 25 or 50 and even the speed at which it goes is maybe not the main consequence for the markets?
Yeah, it's interesting because I always get this question, and I did a whole media tour in New York at the end of last week, and that was, of course, front of mind. And the reason it's sort of a question these days is because the market is sort of on the fence between 25 and 50 in terms of what it is pricing in. And the Fed hasn't really come out in one direction or the other. And so we actually don't really know how the Fed is going to start this rate cutting cycle. But my view always is whether it's raising rates or cutting rates is it's the terminal rate that matters, right? So we need to figure out what is a neutral rate, how far above neutral is the Fed, how much is it justified to move that rate, and then where does it end up? Is the market pricing in a full easing cycle or just a normalization back to neutral? And to me, those are the important things. The economy isn't hanging on by a thread.
No.
That if the Fed doesn't cut immediately, like for instance it did during the financial crisis, the whole system collapses. Like we don't seem to have any of that kind of urgency. So that's kind of how I sort of describe it. So my sense is that certainly the Fed, the basic MO is to go 25 and to go at successive meetings. But we know that the Fed waited longer to cut rates than it might have done otherwise because it wanted to wait for inflation to really have several successive positive prints. I mean, remember, you and I were talking at the beginning of the year, the Fed was, the market was pricing in 6, 7 rate cuts just for this year. And that was overdone. And the Fed kind of pushed back saying, look, we want to make sure we see inflation moderating, which it has done. We got the CPI last week. It
Right.
wasn't a great number, but it wasn't a bad number. And it's been consistently now closing in on the Fed's target. It's not quite there. The core PCE is 2.6. The core CPI is 3.2, but it's certainly better than the 6 to 9% we saw 2 years ago. And it's close enough to the Fed's target that the Fed really is not justified anymore to be as restrictive as it is. So the way I think of it is a neutral policy rate, is inflation plus, let's say, 100 basis points. So that gets you to 3.5, 4. The Fed is at 5 3/8. That gives the Fed, 6, 7 rate cuts just to get to neutral. That's not even like a full easing cycle. And so I think that's where the Fed is going to go unless the economy tells it differently, right? If we are going into recession, obviously it would cut more. And if inflation were to accelerate higher, it would cut less. But I think that's kind of the basic playbook here. And then, if it goes 25 and it goes again at the next meeting is until November. So that's kind of a long time to do that first 50. And so I could easily see the Fed going 50 and be completely justified without spooking the market.
Okay,
Like the markets
interesting.
will say, oh, what does the Fed know that we don't? I don't think, that really is an issue here. And the Fed can easily just explain it, saying, look, we waited longer. We got plenty of room here, so let's just jumpstart this. And Greenspan did the same thing in '95 when he gave back some of the rate cuts in '94. So I think it doesn't have to be an alarming story at all. And I think it kind of makes sense to go 50 because it did wait and it does have like another 7 weeks till the next meeting. And the Fed certainly wouldn't want to go intermeeting because that would send maybe some alarm bells ringing. So at this point, the Fed's got 150 at least to go. Why not jumpstart it and get closer to normal or to neutral? Because the Fed is well above neutral at a time when the inflation rate is falling and the unemployment rate is edging higher. So
Oh,
it's
yeah.
fully justified here.
Okay, so let's talk about unemployment in a minute. Just the internal Fed machinations are so fascinating because here we are, sort of in the hours before this decision. Jay Powell, it seems to be telegraphed, wants to go 50 basis points. what kind of job does he have to do to get other people on board to sort of do that? Or, I mean, he could just kind of do it himself, couldn't
Yeah,
he?
no, that's a great question. And actually, I forgot to put up slide two earlier. So let's put slide two up. The Fed obviously wants a consensus, and I think Powell can easily so when you think about the pressure of higher rates on the economy, I think the pressures have not been uniform, which is why the economy it has held up so well, why it's been relatively resilient, and we're talking about soft landings, sort of hard landings. Um, so, homeowners are already seeing lower mortgage rates here at the long end, maybe not on the adjustable end, but mortgage rates are down. The banks really never felt the pinch, at least the mega banks. Obviously, the smaller regional banks did back a year and a half ago. Can you believe it's already been a year and a half
No,
ago
it's hard to
since
believe, actually.
Valley Bank? Um, and so the economy is not teetering on the brink of collapse. And so that would not be the argument that Powell would make, but he would say, look, inflation. So here are three measures of the PCE inflation rate. And as you can see, the forward curve to me is too low. Like the market's pricing in 2.8. That seems too low to me. 3.5 at a minimum seems fair in an ongoing expansion, because that's basically inflation of 2.5, 3 plus some sort of spread, the natural rate of interest, for instance. But that's where we end up is a question, I think, for next year, not for right now. Right now, the Fed has plenty of room. All versions of the Taylor rule, which I don't have this week, but I showed last week, give the Fed plenty of room. And the Powell could just easily could say, look, if we get at least 100, 150 basis points and we waited longer than we otherwise would have, just to be prudent, if we have this much to cut, why not just front load it, and give the markets kind of a jump start? And I think that's a totally fair way to think about it. The Fed does want to be aware about the rise in the unemployment
Right.
rate
Okay.
and being behind the curve. I don't think the Fed is behind the curve, but the slower it goes and the longer it waits, the more risk there is that could happen. And I don't have the chart this week, but last week I showed the chart of the labor vacancy rate, right? So the demand for labor via the JOLTS report. And during the pandemic, we all know the story. We had a very tight labor market, and there was 3%, that there was excess demand for labor, totaling 3% of the labor force supply. That is now down to zero, which is good because it means the jobs market is in balance, which means it's likely going to be less inflationary. But that pendulum of the unemployment rate and excess demand or supply of labor, that pendulum rarely stops swinging right at the moment that you want it to stop swinging, right? It tends to kind of continue to go, and the Fed has to be aware of that. So I think the longer they wait and the less they jumpstart a rate cutting cycle, the more risk there is that the unemployment data keep going in the wrong direction, and that in 2025 we would be in a recession. And so why not, if the clear and present danger has passed for inflation, even if it's not yet at the Fed's target of 2%, why not kickstart this thing now? And they can always pause later if they need to. So that would be my approach if I was at the Fed.
So what's going on in the markets has a lot to do certainly with interest rates and some of the stocks that will have the companies that will have a lower cost of capital going forward, and will price that in ultimately. And then the rotation out of the mega growers, which you've been talking about for some weeks now, which to some are a separate story from the interest rate story entirely. But there is this rotation happening, and there's reasons to connect it all. Tell us a little bit about where you think we are in that and the type of continuum that we might be in for here.
Yeah, so let's go to slide 15. So the mega cap are, of course, its own thing, but they are very much part of this rotation story driven by a Fed rate cutting cycle. And so just to kind of backtrack here for a moment. So this is the S&P 500. The orange bars shows the absolute breadth of the market. So above zero is good, means broad participation. And right now, about 75% of stocks in the S&P are in uptrend. So that's the breadth numbers are good. But the purple line is the relative breadth. So how many stocks are making new relative highs to the S&P? And you can see for the past, six plus months or so, the relative breadth has been narrow. And that's merely a function or purely a function of the fact that the S&P cap weighted index has so much beaten the equal weighted index. They've both been going up. So it's not like a 1999 story where the market was really distorted, but the cap weighted is just going up that much more than the equal weighted. And that makes it very hard, if not impossible, for the typical stock to outperform, which is why the relative new highs has been negative, even though the absolute new highs has been positive. And so the rotation started in July. If you remember when the first CPI report was released, that clearly showed
Absolutely.
some real improvement.
Right.
And the market at that point said, okay, you know what? That's going to be the evidence that the Fed needs to start a proper rate cutting cycle. And if you remember, we had some pretty violent rotation, and it actually knocked the index down because these Mag 7 stocks are so big that if they go down, the market goes down. And fortunately, the last few weeks, we've seen a sort of kinder iteration of that, where the market actually has been able to go up, even though the rotation continues. But for me, the rotation is really very simple. Obviously we had kind of the flight to safety trade during the rate hiking cycle. Investors flock to these mega growers because they basically don't care what the Fed does. They generate so much cash flow that they don't need to refinance debt because they don't have any debt. They have excess cash and they're using that to buy back their shares. And so these stocks were considered to be immune to the rate hiking cycle, whereas banks or industrials or real estate companies, anything tied to interest rates or the shape of the yield curve, were held back. And now that the Fed is embarking on a rate cutting cycle that should be at least 150 basis points, it's the rest of the market, it's the everything else trade that can breathe again. And that's why we're seeing some real positive action here in the broader market. And again, the question for me is, there's the fundamental macro story of interest rates, earnings. Where are we in the earnings cycle? Are we going to have a recession? But then there is kind of the technical aspect of, if the market broadens, can that happen in a rising market? Or are the stocks that are being rotated out of so big that whatever they do, the index will follow? And to me, that is kind of more of a technical question that we're going to be talking about. But the good news is the last few weeks, we've seen this broadening now that the Fed, is about to go. And that broadening was actually kind of a benign broadening, if you will.
It was. And as you say, a change up from what we saw sort of in the summer at a different point. It spelled out for us in a way the consequences, like if you are able to stock pick, which lots of people who have good fund managers will do that. Who cares if the S&P can't hold?
Yes, that is a great observation. And actually, if we go to slide 8, we can see the S&P 500 equal weighted. And so, yes, the answer to the conundrum is to paint the exposure with a broad brush. And I'm having the same conversation here with my colleagues over in the asset allocation group. But yeah, so this is a time where active management should do better than passive management, and where kind of a down cap exposure, whether you're just going from S&P cap weighted to S&P equal weighted, or you're going, you're adding like a Russell 2000 exposure, or even non-US, that's kind of a proxy for the Mag 7 mega cap growth trade, because it's sort of the everything else trade. And we've had this conversation in the past, and many times they've been premature. But that to me is a way of insulating yourself from being too beholden to the cap weighted index, because the irony is that, so here you see the equal weighted set a new near a new all-time high. It's looking pretty good. You see the correlation between the S&P equal weighted and cap weighted briefly went close to zero back in July. That's how much distortion there was. I mean, remember, these are two indices with the exact same constituents, and they were almost negatively correlated. Now they're back to positively correlated, which tells me that the markets are in a sense of balance right now. But so, the risk, of course, is that the rotation doesn't happen and you're in indices that lag behind, the headline indices. But to me, this makes a lot of sense. It's just to broaden the brushstrokes and go active, because the irony is that if the market broadens here, but the headline indices don't make much progress because the Mag 7 stocks are so big, they're about 30+% of the index. The irony would be that, let's say 80% of stocks are in an uptrend, but your portfolio doesn't benefit from it because it's being held back by a handful of mega cap stocks. And so one way I think to address that is just to be more active and to paint the market with a broader brush.
Right. Okay. You mentioned in some of your writings that financial conditions remain favorable while earnings are growing and the cost of capital is coming down. Why are financial conditions favorable this second? I mean, we know what we're coming into. We think we know, which is an easing cycle. But just talk a little bit about financial conditions. I mean, basically, we've been able, in the United States particularly, to sort of grow with high interest rates, essentially.
Yeah, and so we'll pull up slide 16, which is my attempt at making like a radar type chart.
Cool.
But this is my attempt at creating sort of an investment clock. And we're in the upper left quadrant, which means that earnings are growing and financial conditions are relatively loose. Bottom right would be the worst quadrant to be in. I mean, earnings are falling and financial conditions are tight. But financial conditions are a real-time view into the economy via financial markets. So it's something that the Fed looks at because the economic indicators that the Fed looks at and that everyone else looks at are almost by definition lagging indicator, right? Inflation, employment are all lagging indicators. So financial conditions are kind of a window into the real-time behavior of markets as they gauge where the economy is going. So we tend to use the Goldman Sachs Financial Conditions Index, which is based on the dollar, short rates, long rates, credit spreads, and the stock market. And so these are all real-time indicators. They're not always correct, right? The market can overreact or underreact and give a false signal. But what we're seeing right now is that financial conditions are looser than average. And that's, of course, primarily because the stock market has rallied, also because the dollar has fallen, credit spreads remain stable, and long rates are down, right? The 10 years at 3.63, it was at 5%, almost a year ago. And so all these market movements are pointing to looser conditions. Like you said, despite the fact that the Fed is at 5 3/8, but the markets are anticipating an easing cycle, correctly, of course, but they've been anticipating them for a while. And at the same time, the economy does remain relatively robust, which is why credit spreads are not signaling anything. And actually, if we go to slide one, you can see how balanced the market is right now. So this is the VIX index, and of course, you see that latest spike. That was the unwinding of the yen carry trade. Was very brief, fortunately.
Look at that, though. That's quite a spike.
That was huge. That was
massive.
huge. And it was technical. That was the Bank of Japan raising rates unexpectedly while the Fed was poised to lower rates, and that kind of caused an unwinding of these carry trades. And it was sort of a one-time shot, at least it looks that way. But overlaid against that, you see the high-yield credit spread and the equity risk premium. And you can see, like, when that vol spike happened, credit spreads didn't widen, and that was a good indication that that was a technical event, not a fundamental event. And so right now the VIX is around 14, spreads are well behaved, the equity risk premium is reasonable. And so it shows a market that is relatively imbalanced at a time when the Fed is going to lower the cost of capital, and at a time when the earnings cycle, which we can show in slide 11, remains pretty robust, right? So earnings for 2024 are on pace to grow about 9.5%. For 2025, they're expected to grow 14.5. Maybe that's too high, especially as the economy continues to soften. But the earnings story looks good. The average stock in the U.S. trades at an 18 multiple, and interest rates are coming down. And it's like, that's a pretty good backdrop if you're an active investor, especially in the face of all these other stocks, the everything else trade being sort of left behind. And again, the rest of the market hasn't gone down, but if you look at since the October 2022 bear market low, S&P cap weight is up 62%. I think the equal weighted's up 44%, and the Russell 2000's up 33%. And so you can see how when you go down cap, the returns have been good, but not as stellar. And to me, there is a catch-up phase that could be happening, in the coming months.
Catch-up, melt up. Would you go that far?
I wouldn't go melt up just because if we have the catch-up, by definition, it means that you're going to have the rotation, right? I mean, it doesn't actually, I shouldn't say that, not by definition. Like, it's possible that investors just put money in the rest of the market, and it's new money, right? It's coming out of money market funds or whatever. But if it's rotational money coming out of the mega caps, then I think the headline index is actually going to underperform the equal weighted index. And by definition, that would not be a melt up. But we don't really like melt ups. Melt ups are not sustainable. No. So I would rather have an orderly, balanced, advanced, because they tend to last longer.
Right. And to an extent, the idea is normalization on some level. So there's sort of that there. You've noted in some notes, what do we make of gold ultimately? I mean, this is the nervousness. This is parts of the bond market that you'll look to that sort of worry a bit.
Yeah, so slide 5 is a chart of gold, which continues to make new highs. And actually, my Alex Steele on Bloomberg on Friday asked me, Jurrien, what's the deal with gold? And I said, 2 words: fiscal dominance.
Right.
And so what gold is telling us is that, we're obviously in an era of fiscal expansion. The deficit story is well known and is likely to continue regardless of who is going to be in the White House. And so that fiscal dominance or fiscal expansion is now being met by monetary accommodation, right? So you look at the economy, if it indeed is soft landed, and now we're going to have an easing cycle, that's going to boost the liquidity profile. And if nothing else, gold is a play on excess liquidity, the money supply. And so you combine fiscal expansion and at least a neutral monetary policy instead of a tight monetary policy, and it suggests that that liquidity will start to grow, and gold is essentially a play on monetary inflation. And if we can pull up slide 3 for a moment, it's interesting that you mentioned the banks earlier, but the Fed is about to go presumably 150, maybe 200 basis points. And you look at where bank reserves are, right? They are still high, above the level pre-COVID. They're below the level following the big stimulus during COVID, and that's because of QT by the Fed, of course. But they remain very high, and they remain so at a time when the Fed is going to start cutting rates, right? And the Fed hasn't announced anything about the end of quantitative tightening, but I don't know how much sense it makes to be cutting rates and shrinking the balance sheet at the same time. So a new easing cycle is starting while bank reserves are more than ample. And so again, it's not, the Fed is not cutting rates at a time when the whole system is so tightly coiled, on the brink of collapse, right? Yes, rates are high, but the banking system is fine. Homeowners are fine. Many of them locked in, sub 3% mortgages. Corporates are fine. Their window for refinancing is several years away, and by that time, rates might be lower still. And so this easing cycle is happening at a time when the economy is relatively imbalanced.
Okay.
And I think gold is kind of telling us, like, we could end up reaccelerating down the road with more liquidity growth, and that's what gold is telling us.
There's a couple of questions. We'll get to as many as we can here. They're just rolled in right now. So in the short term, in a 60-40 portfolio, are either stocks or bonds expected to do the heavy lifting?
I think so. It's a great question. And the good news about the 40 side is that in recent weeks, the 40 has actually played the role that we have always expected it to play, but that it didn't play during the rate hiking cycle in 22 and 23 when bonds became positively correlated to stocks. Right now, they're negatively correlated, so they are kind of the recession insurance. So either recession doesn't happen and the stock market continues to grow because earnings are growing, cost of capital is coming down, and then the 60 does the heavy lifting. And if we do end up in a recession next year, then that 40, even at 3.63%, still has value, because in that situation, the Fed would embark on a full rate cutting cycle rather than just kind of a half a cycle back to normal, but it would go all the way through neutral to an easing cycle, and then presumably you would get more oomph out of the 40 side.
Yeah, and the Fed has room to do that, which is sort of underpinning so many different things. Okay, couple of questions here. Let's put this one to you. You mentioned a little bit the U.S. election. So this question is basically back to vol. Like, will the U.S. election present some level of market volatility? To what extent is this going to happen through the next few weeks?
I don't think so, barring an extreme outcome. Okay. But the way I think of it is the market is expecting one of two outcomes, right? Either Trump wins, in which case there's likely a Republican sweep, and we can talk about how good or bad that may be for humanity. I'm not going to make political, judgments here, but from the market's point of view, that would be a relatively business-friendly outcome. At least that's how it would be perceived. And the alternative is that Kamala Harris wins, but the Republicans keep the House and take the Senate, in which case you have a divided government, in which case, and again, no political judgment here, in the eyes of the market, whatever progressive anti-business agendas might be pursued will get hamstrung in a divided Congress. And so I think this is the reason why the market has been relatively chill, despite some pretty extraordinary developments, right? The first debate, the assassination attempt, the withdrawal by Joe Biden. And it reflects a very deep, balanced, and liquid market, but it also reflects, I think, the market's perception that the two outcomes that are in play are at least not bad for the economy or for businesses, I should say.
Okay, thank you. And thank you for sort of putting that into perspective and into the context of the markets. Jurrien Timmer, great to see you. Thank you so much for joining us today.
Thank you very much.